So now let's talk about the fund manager fees. In essence, the mutual fund managers charge the fee to cover all the other fees created to make a transaction, and they add in some profit margin. And it's hard to clearly identify the weighting of how much each smaller fee holds as an expense in the mutual fund, as each one is unique to itself with expenses and costs. So with each of these fees, it's important to know that the mutual fund's overall performance that you receive for a rate of return is calculated based on the performance of the assets within that fund minus all these additional fees. So try to think about it in this way instead. These are the fees that you pay yourself when you take control of your own finances as you become your own money manager. There can be considerable savings by doing this managing yourself, and your money is invested how your risk tolerance is, not in a fund that the advisor knows about the most information about. So the next few fees would be what is buried within the management expense ratio, or MER fees. And management and expense fees, which is charged for providing management of the fund facility to investors. Consider this the bulk of the fee you exempt by your learning and doing the work yourself. These are the costs paid to the fund manager for adjusting whatever he wants to invest inside the mutual fund. Then they would consist of stocks, bonds, debt certificates, and several other financial assets. And the fund manager will be the expert that decides when to buy or sell any of those assets within the mutual fund. 12B1 fees are marketing fees, and this covers the cost of trying to get more investors' interest to build the pot of money for investing more. I definitely didn't know anything about this fee until I went down the rabbit hole, but needless to say, it makes sense that there would be a marketing budget allotted for interesting other advisors who want to invest clients' money in the mutual fund. Either way, you need to ask yourself, should you be paying for this? So lastly is the brokerage fees, which are chargeable to a broker and is sometimes charged to the investor and sometimes covered by the mutual fund company. So these are the fees that will make sense later on as you open your own brokerage account. And they are a necessity to trading and investing in business, but it is something you don't have to pay a lot for if you shop around. So here is something to consider as well, is that a good percentage of investors are mostly passive in that we use mutual funds as our investment of choice. And we just keep buying more mutual funds until it is time to retire, and then sell a portion of our mutual funds to use in our retirement. Regardless of whether an investor makes any portfolio changes or not, these MER fees are charged every year and a cost to you. And the fund advisor fees are usually a one-time charge, as they are really just selling the mutual funds as a product to you. So this whole illustration is to articulate that management fees can add up quite a bit over time and are charged whether the fund makes money or not. And these two fees to the fund manager and fund advisor could be comparable to what you would pay yourself as a performance of your investing skills when you take control of your own money.